Has that worked? Recording live. It's recording, but how do we? It doesn't look like we've let people in now. Oh, we have.
So we're open now?
Okay, we're just going to give it a minute for everybody to join.
Lee, maybe you can just let me know when we're ready, because I can't see when I can't see the people joining.
Yeah, I mean, we can start. I mean, people have joined.
Okay.
And then if more people join. Fine.
Yeah. Yeah. We're recording, so it will be available in recording. So I want to welcome everybody to the BMO and Sarah's webinar, Dreams to Reality. I'm Heather Usick from BMO Healthcare, and I'm here with Lee Tesler from Cirrus Consulting Group, the leading lease negotiators in Canada.
Thank you, Heather. Thanks everybody for joining. Just some housekeeping. As you know, this is a CE accredited course. You will receive one CE credit. I think it takes a while to get the credit sent to you. Also, before we start, I'm just gonna, you should see a poll, an intro poll. If you could just take a minute to fill that in, just gives us a good understanding of kind of where you're at. It should be 6 questions that you can see. Yeah, so just take a minute to fill those in. Again, just to kind of give us an idea of where you're at in your career, where you're looking to start a practice, relocate, open a second practice, expand, etc. So I'll just give that a minute for you guys to fill that in, and then I will pass you back to Heather. But for the purpose of today's webinar, again, looking at sort of finding the right team. I think that the key message here is having the right team of people, whether it's the finance, the bank, the lease negotiator, accountant, just having the right team is really, really important. And we're going to look at some tips and tricks of starting a practice from a banking perspective, and also seeing where you are with your practice as well. And we will have some questions and answers. There is a question and answer button at the top, so we're going to try and leave some time at the end for some questions and answers. But if you do have questions, please submit them into the chat and we will get to them after. So it looks like everybody has filled in their intro poll. So I'm going to pass back to Heather.
Okay, well, today I'm going to show you what the bank thinks about your finance request, how we view things, and how you can prepare. And then Lee will follow with lease negotiating tips and pitfalls. So, Lee, do I have control of the?
You should have control. If you don't, then
I don't. Oh, just a second.
Yes or no? Ooh. Oh, sorry. Now I've stopped sharing my screen. The wrong button.
I don't think I did.
Okay. My apologies.
Put that back up there.
Okay. I'm going to give you control.
Okay. So I'm from BMO Bank of Montreal, and I'm going to draw from our program for dentists. So maybe we'll flip to the next slide.
You should be able to do it now.
Oh, okay. I can do it now. No, I don't think it's giving me control.
Okay, I'll do it.
Okay, so not to state the obvious, but just keeping in mind that there are likely associates on who've never owned a clinic. So starting from scratch, either with a purchase or an acquisition. So we have clinic loans and we have real estate loans. Those are the two categories that you'd be looking at. Under clinic loans, we'd be looking at startup financing. We'd be looking at leasehold improvements, renovations, expansions, and purchase acquisition loans. And under that would fit operating lines. So we'll get into a little bit more specific about the loans later. Real estate loans for the purchase of the property, a little bit of a different animal. So those would be looked at in two different ways. You can flip to the next slide. So what to bring to the bank? The more efficient you are, the more efficient we can be. And the more thorough you are, the quicker we can get on things and do a complete analysis. So this is very high level, but for startups, obviously we need to know what the plan is. So that would include budget, it would include estimates, timelines, how you're going to get your staff, how many operatories you're going to have, all the details, what the location is, who's the competition in the area, all those kind of things. And we do have a business plan format available as well. So you can just request that from me if you need that. And for an existing, 3 years financial statements is pretty standard for banks. So that will show us the trend. Sometimes we will look for more if if there's a reason to have more history, or but it's not usually less. Unless you only have 2 years, if you're a fairly new entity. Also, accountant produced projections for a startup are very important. And what we're always looking for from accountants is not overly conservative. We want what actually the accountant would estimate. Sometimes there's a tendency to be overly conservative, but that really doesn't serve you well. So it would be better to be what they actually think, not the ultra conservative, but realistic, obviously. Production reports since your last financial statement, you cannot go wrong by providing those. Always a good idea. Just run them off your system and include them in. And personal financial statement, that's provided by the bank. And when I send out my email with all the information, I typically will tell you what you should fill in and things you don't need to. Like, we really don't need to know about, you may have jewelry, you may have artwork that's worth something, but that's typically not included. So we give you guidance. You can go to the next. So the way the bank views your request, it's really high level, 3 buckets. So the first thing we're going to look at, you've heard cash is king. So cash flow, that is what you're going to use to pay your loan. So we start with the cash flow. We want to know how much cash is generated from that entity. So if you're looking at purchasing a clinic, then we would look at the financial statements. We would ask a few questions. We'd normalize them. And then we would do our debt service calculation. So underneath, I've included that's net income plus amortization expense we add back in, and interest on long-term debt. We take that figure and we divide it. We may normalize it a bit more too at the bank, but this is just very simplistic. We divide it by all the debt payments for the next 12 months. And that gives us our debt service calculation, which we would like to see at 1.25 times. What that means is you're going to pay your loan off 1-to-1, plus have a 25% cushion. Because we don't want you running so close to the bone that's all you can do is pay your loan. We want to have that cushion as well. The second thing is the security. So for the dental clinic, we would take a personal guarantee. That's called soft security. And for real estate, obviously, we take a mortgage over the real estate. We'd also look at investments, equipment. That's hard security. So we would take a charge over the dental clinic. That's standard banking procedure as well. So the third thing that we would look at is leverage. So what is the amount of debt compared to the value? So typically for an acquisition, we'd be running at 100% leverage because we're financing the entire thing. So I mean, it depends on the situation, it varies, but that's where we would start looking at 100% financing, and then we would do our analysis and ensure that that loan was safe and sound, which I just want to mention is also in your best interest. The bank is doing its due diligence, but that is also something that protects you. And the more the bank is responsible and analyzing and making sure that that loan is safe and sound, the more safe and sound you're going to be as well. You can flip to the next. So part of that is credit scores. Won't spend a lot of time on this, but beacon score, we would look from like 700 to 900 would be a good solid beacon score. So we're making sure that that will show if there's an issue. Sometimes it's a red flag. We can see if somebody is looking for financing from several places, then it just alerts us so that we can then ask that question, is there an issue, or, but we can also see how solid you are, how you pay your debt. Are you under leveraged or over leveraged? So it gives us some insight as well. So watch over your credit score, make sure you pay your debts on time. And if you know there's an issue, be upfront. Just tell us because we need to know. Okay, next. So so the different types of loans, we talked about the different loans for the clinic and for the real estate. So an operating line is a revolving line of credit. It would have a floating rate, so it floats with prime, and that operating line should fluctuate. It should go down to zero and back up and down again. It covers the operating gaps. So if you pay out a big payment, say you pay your payroll, but you happen to have paid a lot of other bills, that will float and it will cover that payment so that you're never overdrawn, and or hopefully never overdrawn. Term loans, they're fixed rate and floating rate. Fixed rate, you should always be aware that with a fixed rate loan, whether it's 1, 2, 3, 4, or 5 years, you're locked in. And so if you try to pay out that loan, there's going to be a payout penalty. So you're assured, it gives you the security of knowing that that loan is that rate is never going to change for that time period. But it also comes with that payout penalty should you try to pay it out sooner. The floating rate you can pay anytime. And one of the things that you could look at if you wanted the security of knowing that that fixed rate is there, you could do a portion that's fixed and a portion that's floating. You can also, depending on your situation, you could also look at doing 2 fixed rates, one for a different term, say one for 2 years and one for 5 years. I've seen that done, not often. I saw it done in real estate one time. So it gives you the opportunity to pay onto your loan when you have cash flow with no penalty, where a portion is also protected. You can go to the next.
Okay.
You can go, yeah. Okay, so this is the process. So you bring in all of your information. I would provide you with a comprehensive list of the information we would need. You bring that in, and then we would do our analysis. So we would take all that information, we would look at it, we would, maybe have some questions for you. We would create a discussion paper that gives you a summary of the financing that we are proposing and the terms and conditions. You would read that over, ask us questions. We'd have, as it's a discussion, because it's a discussion paper. And when you're comfortable and we're comfortable, then it's signed. And then we can begin the underwriting. So the underwriting process begins, and at the end of the underwriting, it goes to our credit partners. Our credit partners adjudicate that loan. Maybe they come back with some questions. And one thing I do want to say that differentiates BMO at this point is we have our discussion with our credit partners very early on. And so you don't have any surprises at the end. It's not like there's a tendency in some circles to send out a discussion paper that hasn't been reviewed. And there's always a risk with that, because when you get to this point where you're working with your credit partners now with your application, there can be some dramatic changes, but that typically does not happen with BMO because we have those discussions early on. So unless something changes, or there wasn't full information, that will not change or change very little. So then comes the approval or the adjudication. Hopefully there's an approval and you will sign security. Then when all that's signed, you work with your lawyer, sign off on everything, it gets back to the bank, the loan gets drawn down. You can go to the next slide. So this is another part of the due diligence the bank does. Risks versus mitigants. So first of all, it's a matter of identifying the risks. So there you can see I have a few risks that are on the scale. Startups always represent a greater risk than acquisitions because acquisitions are known. It's a known entity. And what's unknown is always riskier. So so the way that we would look at that, we would identify those risks. Okay, it's a startup, low personal net worth. Maybe you're a young professional, haven't had time to build net worth. So then we would look at the other side. Maybe you're working as an associate. We look at your T1s, we see, oh, they're making a good amount of money working as an associate. So we have a starting point. Then we look at your business plan and we start going through that. So we find the risks, and then we look for ways to mitigate those risks. If you're very experienced in the industry, that's one of the mitigations. Maybe you had varied revenue streams. Maybe you have a spouse that has a very high paying profession. So those are things that all fit in there. And having said that, it doesn't necessarily mean that we would take any charge over those things, but just knowing they're there represents a mitigant oftentimes. You can go on to the next one, Lee. So building your team. We did a webinar earlier on with Sandra Reeder for HR, and who has an HR company, and we talked a lot about building your internal team. So now I'm going to just talk for a minute about building the team, the external team, if you will. So you have your banker, your accountant, your lawyer, those are basics. You want to have people who communicate with each other, people who are known, and people who you can communicate with who aren't talking down to you, or, that make sure they're available, those kind of things. Another key person on your team is obviously your lease negotiator. The lease can have very far-reaching effects. We all know people who have gone to sell their clinic and suddenly found that they have a demolition clause or some nasty surprise that hinders the sale of their clinic. So Lee is here to ensure that you get the best possible lease terms and conditions. So on that note, I will hand it off to Lee.
Okay, thank you, Heather. So I normally start off with these three numbers, 85, 54, and 80. And what does that mean? So we found that 85% of dentists have a lease that can prevent them from selling their practice. 54% of dentists across North America are overpaying in rent. And 80% of landlords will structure the lease to give them at least 50% of the proceeds of sale when the practice is sold. So I just wanted to start with that, just to think about that, and we will obviously get into a little bit more detail. So Cirrus, who are we? Why have we been successfully representing the dental community for over 30 years? Well, we're a healthcare and dental specialized tenant representation firm, founded actually by a couple of doctors over 30 years ago in Western Canada, that found that the landlord was taking advantage of the healthcare and dental tenant. So since inception, we've negotiated over 13,000 dental and medical office leases. I would say 75% of our clients are dentists, but we do other healthcare practitioners, veterinarians, general practitioners, health and wellness, podiatrists. We really do cover healthcare across the board. And what makes us unique is we have an in-house legal and leasing team comprised of real estate attorneys, some with a background in healthcare, some former real estate brokers, and some that we've actually retained and hired from the landlord side, or the dark side, you could say. So I'm the senior consultant. I oversee the Western Canada team. I've been at Cirrus for nearly 6 years now. And I also lecture giving continuing education seminars across the country and throughout North America at some of the big conferences, and we represent at the PDC, etc. So why do we exist? Well, what we found was the sort of sweet spot in between a broker and a lawyer. Now, again, I'm not here to disparage any brokers or lawyers, because we work with plenty of brokers and plenty of lawyers. But what we found is that the broker essentially will help to find the space. They get paid an awful lot of commission once that deal goes through. So, they're slightly more incentivized for the deal to go through. And then the lawyer, who will, in some cases, will look over the lease for the legal provisions. But normally, again, they will redline the legal provisions. And in some cases, they may actually just pass that back to you to present to the landlord. They don't necessarily enjoy the actual negotiation part of it. Like if the landlord was to say no, what do they do? Whereas we get directly remunerated by the dentist. We focus on the business and financial clauses. We have a lot of data to, help with our strategies, and we treat the project. If it's something that's not good, we'll tell you to run rather than walk. So, as I said, we do pay for a lot of proprietary real estate data. So we have access to over 95 billion of square footage, and obviously some of our intellectual property. I did ask one of my team just to put a slide together on just the current kind of market update in Vancouver. As you can see, rents are still on the up, even vacancies, even though the vacancies started to go up, as you can see from sort of 2020 when COVID came in. Hasn't been a real dip in the market per se in Vancouver. Rents are still high, and the projection is that will continue like that. So there's still a lot of demand. Again, this is just very broad. In Vancouver, we can drill down any sort of property, any location, any type of building, medical plaza, and get a lot more granular. If you have a particular address or a particular location, even a radius that you're looking to start a practice, we can certainly look into that in a bit more detail later, if we speak later. So what's the financial impact of the lease? Now, I'm going to talk a lot about leasing, but also if you were to buy and actually purchase the building. But what is a lease? Now, normally on my in-person seminars, I would ask the room what they think a lease is. Obviously, it's a little bit more difficult here, but essentially, it's going one of the largest transactions you're going to make in your professional career, aside from your residential property. If we take for an example of a monthly rent of $5,000, $5,000 per month, and we're just talking here about the base rent with annual increases of 3%. Now, dentists are some of the best tenants on the planet. They have the lowest default rate in the country, and statistically, they actually stay in their spaces for 23 years statistically. So even if we just took this into account over 30 years, right, with escalations, etc., you're looking at nearly $3 million in tenancy expenses. So again, our job is to stress why you're such a good tenant. You're not a restaurant, you're not a nail salon, you're not a dry cleaner, and that's one of the reasons why lots of landlords will approach us and want a healthcare professional or a dentist certainly in their building. So what do we normally recommend if you're going to start a practice? So if you're going to start and build out from scratch, like Heather said, there is the difference between acquiring an existing practice and buying or building out from scratch. So we would always recommend, in any case, a 10-year lease with 2 5-year renewals. So you want to have options and you want to have term and runway. You don't want to invest $1 million into a new space, and after 10 years, the landlord says, thanks very much, and you're not going to be renewed, or you have to relocate, etc. Like, it's going to cost you a lot of money to build out. So it's vital that obviously the lease is negotiated correctly, but in terms of the financials, and we'll touch on a little bit of that a little bit further, it's very important just to know some of the critical dates involved. If you do have a 10-year lease, when does that 10-year expire? If you have a 5-year option, do you have to give notice, 6 months, 1 year? Because landlords very unlikely will tell you when that option deadline is approaching, because if you miss that, essentially they're null and void, and landlord has a lot more leverage. So again, it's just understanding and not falling into some of those trips. So again, I touched on buying versus leasing. Now, lots of people always ask me, what should I buy? Should I lease? Again, really depends where you are, where you're looking, what your financial situation is, how much Heather and the BMO are going to be able to lend you. It's going to come into consideration. But from our perspective, there's still a common denominator with a lease. Even if you lease, even if you become a landlord, it requires a big, large upfront investment. You then become a landlord. You are then responsible for that property, right? If something goes wrong with another tenant, you're responsible, and you've got to deal with that. Maybe in your daily life when you're practicing dentistry. Yes, you have greater flexibility on how to use the space and freedom of control, but you are essentially a landlord. If you sell the practice in the future, do you want to keep the real estate? What happens if somebody else wants to come in the future? Now, leasing, for sure, it only requires a smaller upfront payment, and you do have greater working capital. And you have the flexibility if you're in an area or for whatever reason that demographic changes over the years, you can have the flexibility to move. But the point I want to make is whatever happens, even if you own your own building you practice in, and a lot of people say to me, I don't need a lease, I own my own building. Well, that's actually wrong, because you still need a lease, what we call an arm's length lease, to separate the building corporation to the practice corporation. Again, there's a number of reasons. We don't have all the time to get into that today. But from a tax standpoint, from a liability standpoint, and also it adds value to the practice if you have a record of rental payments. Even if you're paying from one company to your own company to yourself, you then have that And if you decide to sell, you're putting something in front of someone rather than just quickly pulling something off the internet, a couple of days before. So what are the 7 financial negotiables in your lease? So when we talk about financials, we talk about base rent. So what is the base rent that you're paying per square foot? Now, most leases nowadays are what we call a triple net lease, which includes your TMI, your tax, maintenance, and insurance, and your common area and maintenance. So for the tax and the insurance, they're not really negotiable from the city. Where we look at is the common area maintenance. What are you paying for? Are you getting detailed itemized statement? Do you have a right to audit? What happens if you're paying a certain amount a month, and then at the end of the year, landlord decides he's made changes to the property, he's redone the roof, the HVAC, and then suddenly you're hit with a $10,000 bill that you weren't expecting. So there's ways of actually, limiting some of that liability, just to make sure that you have full transparency and the landlord has accountability. Now, when starting a practice, you will have a fixturing period. We look for around 3 to 6 months of a fixturing period or free rent as well. And we want to try and get some free rent even when you're up and running, because the day that you get possession and then the day you commence doesn't mean that first day that that everybody's walking through the door. So try and give you a little bit of leeway when you actually turn the key and open for business. Tenant improvement allowance. We will analyze, if the landlord's willing to offer $20, $30 per square foot, is that worth it? Because, you and I and most people, there's no such thing as free money in this world. Somebody somewhere is going to be paying for it. Now, with interest rates, obviously, well, they've just been cut recently, but being a lot higher than they were, in some cases, it's worth taking some of that tenant improvement allowance. In previous years when the interest rates were low, you could finance a little bit more from the bank, and maybe not take so much from the landlord, and that will have a significant effect on your rental payments. So that could certainly bring them down. But again, we would analyze that. It's always nice for the landlord to have some skin in the game, and what work is the landlord going to do, as part of you building out a dental practice. This slide just talks about some of the objectives if you were in a position that you needed to expand. Maybe your office lacks in space. What sort of special equipment do you need? Do you need additional treatment and hygiene rooms? You're looking to upgrade. I think that the point here is using the lease as leverage. Right? You have leverage. If there's a space next door, do you have the right of first refusal on the space next door? The last thing you want to happen is you started a practice and it's going well, and suddenly you're bursting at the seams, and could do with a little bit more space, and then next door you find out that the tenancy's just been vacated and somebody else has come in. Would have been ideal for you to expand. So again, having these rights of first refusal, having some of these stuff in your lease just gives you so much more flexibility. So what important considerations in your current lease? So if you're acquiring a practice, you're taking over an existing lease. Again, what are you taking over? Because you are then assigned the lease, you're responsible, right? So when does that lease expire? Do you have leverage on the next renewal? What is the alterations? What changes are you allowed to make to the space? How much are you looking to spend on leasehold improvements? Use the lease, use the location as leverage. If you're going to be there, you're going to improve the space. It's only going to add value to the landlord. So here, just a few questions. Again, a little exercise. If anything you take away from today, we do have a lease, and I don't want you to go home and panic and phone the landlord. asking what's in my lease. And I would certainly not advise that. But, you know, when does the lease expire? When does the option to renew? When do you want to transition? Are your options transferable? I had a client that was in his late 60s looking to retire. He told me he had 12 years left of the lease, which was good enough to sell the practice. And when I actually analyzed his lease, what transpired was that he had 2 years left of his lease and he had 2 5-year options, but they were personable to him. They weren't transferable. Landlord said, I gave the options to you. I didn't give them to anybody else. So when it comes to selling and the landlord suddenly wants increase the rents by 15% or wants a sum of money to transfer that lease or to give those options to someone else. So all these things you should be aware of. Are you personally liable? If you start a practice, whether you build out from scratch or acquire, there's a good chance you're going to sign a personal guarantee, right? That is really common. The majority of new purchase, new build out acquisitions I'm involved in, landlord will want a personal guarantee. What we don't want is you to be personally liable for 20, 30 years. When you start, you're going to have a lot of debt. You won't have, as much assets and capital, but in 10, 20 years time, when you do have, maybe you've paid off your loans, you have your house, etc. It's amazing how many doctors that I see their lease that was personally signed 20 years ago, and now when they do have a lot more assets and they're personally liable. So, best case scenario, you remove any personal liability, any personal guarantees or indemnities. But if you can't remove it straight away, then, after 5 years, if you're a good tenant, can we limit some of your risk? And again, if you do lease the space, if you do own the building that you purchase, do you have a separate corporation? Who owns the building? Who owns the corporation? Are you paying yourself rent? Do you have a lease in place? When you sell, do you plan to become, the landlord? What's your estate? Have you done your wills and estate? There's so much more and so much more details, and we can certainly take this offline and get into more detail. So look, there are a number of provisions within the lease, as you can see here, that can have a really big financial impact on your practice. I'm not going to go through all of these. Heather touched on demolitions and relocation clauses. They are becoming more common, especially in downtown Vancouver in certain cities. And some landlords, if they can get a demolition clause inserted just of the hope that somebody may want to come and buy their building and then they can kick everyone out. It doesn't mean you can't have a practice. It doesn't mean, you can't sell a practice with a demolition clause in. But there are certain things that we can do to improve the language. Obviously, best case scenario is removing a demolition clause. But if we're aware that there is no plans to demolish the building for 5 or 10 years, then can we get a blackout period? Can we actually increase the notice period, right? You don't want to have 60 days or 6 months notice that they're demolishing the building. It just doesn't give you enough time to find another space, relocate, build out. So can we extend the notice period? Death and disability, that's another provision that we actually very proud that we've inserted into many deals that we've been involved in, which essentially means that, God forbid something was to happen to you, you were unable to practice wet finger dentistry, had a critical illness, worst case scenario, passed away. This clause will allow your estate to terminate the lease agreement regardless of the number of years remaining. So there is one provision that I talked about before. I'm going to just touch on it briefly. This is the option to renew language. I'm just going to give you all 1 minute just to read through this while I take a sip of water. And then we're going to just go through this example. And I don't feel sorry for you, because I have to read through 40 pages of leases and provisions like this every day. So again, this is an option to renew language, which I touched on earlier, which is found in 90% of leases. Now, what can we see in here, or any sort of red flags? Now, we touched on that before. Provided that the Dr. Joe Black shall remain as the tenant. So that's the first thing. If you're not the tenant, those options may not be transferable. If the tenant has regularly paid its rent and performed its covenants, obligation on the lease, and not been in default, again, this is pretty standard. Any such renewal should be on the landlord's current standard form lease. This is a lovely little trick that landlords love to have in their leases. So you may have negotiated a lot of good clauses that are a little bit more tenant friendly rather than landlord friendly in your lease. And then when it comes to renewal, you exercise the option, and then the landlord puts you on their current standard form lease, which may include a demolition, a relocation, etc., etc. So it says here that in no event shall the rent be less than it was in the last year of the original term. Again, landlords love this language, and it's not always easy to remove, but it's certainly a conversation that can be negotiated, right? They don't want you to be paying less than you were the year before. You're sort of going on a roller coaster, just going up and up and up, right? But certain times in the market, if you look at back in 2008 with the global recession, even in COVID, like, if the market has changed and suddenly you're paying up here, and then it comes to renewal, and in terms of fair market value, you're paying way above fair market value. If you have this in your lease, landlord's not going to negotiate a lower rent. And then lastly, it says rent shall be determined by arbitration based on market rents for renewing tenants in the building. Now that's the red flag, is what's highlighted based on, I mean, you don't know what other renewing tenants, what any other big anchor tenants, what they've renewed on, right? You don't want to be restricted by that. So, I mean, essentially there's 5 or 6 red flags in that one provision, the option to renew provision. Now, the cost of this mistake, inability to sell the practice, if you have to absorb, an increase in rent, if you're liable beyond sale, it could cost anywhere from $250,000 to $750,000. Now, this is a slide that I got from one of my clients, just so that you see what landlords actually do. So this client had a 5-year option, was required to give 6 months notice, which they did not do. Landlord sent them a letter. Please be advised that my broker will be placing a full lease sign on the premises this week, and he'll show the premises to prospective tenants, just for missing the option. So if you're practicing and suddenly the landlord's showing other prospective buyers, I mean, tenants, certainly would be a code red, and landlords, they don't care. They're looking at the bottom line. So we touched on there are a lot of other clauses within your lease to review. So this is a slide that I actually got from the landlord side, what we call the tenant lease cycle. So again, the important thing here is leverage. My VP of leasing says to me all the time, like, the earlier you start the conversation, the better it is, right? Because landlords can, certainly we recommend 2 years before expiry, right? And landlords will say, you've got plenty of time, or, they'll slow play and get back to you. you know, ideally they want to get you into that kind of 8 to 6 month period, because like we said before, if you miss your option, then that becomes difficult. It doesn't mean we can't renegotiate. There's plenty of people that have missed options or have no options. There's still, everything's negotiable, but again, it comes down to leverage. So we recommend 2 years before expiry. We don't want to get into that 8 to 6 months, because the likelihood of you moving or relocating, if there is a problem, is very slim, and the landlord knows that. So why are we successful? Why have we been successful for winning lease negotiations over 30 years? Because we have a process and a strategy that works. We don't just pick up the phone to the landlord. We spend time with you, the client. We gather all the documentation, all the information. We try to understand your practice goals, where you are, if you're just starting, if you're mid-career, or you're looking to sell, trying to identify that. We then obviously will review your lease for any liabilities, any areas of concern. We will prepare our market research. We'll do our due diligence. Have we worked with the landlord before? Do we know any other ones in the area? What is the current rental rates? What are the current vacancies? And then we develop a strategy. And we've done these 5 things, and we haven't even reached out to the landlord at this stage. So when we go to reach out to the landlord to discuss some of those lease financial terms and the legal, we really are prepared. And again, we're not going in guns blazing. We understand that you have to work with these people for a long time. So we try and educate them, explain that we're being remunerated by the dentist. They're extremely busy, being chairside. And once we kind of explain and educate, normally leads to a successful outcome. So we will then review the final, executed lease with all the changes and amendments that we've made, just to make sure that what you're signing, the last document, there's no last minute changes the landlord's put in. Now, we have what we call a critical dates and risk analysis, which has a $2,000 value. So if any of you actually have a lease, an existing lease, a letter of intent, or even if you're looking to start a practice, we will spend 3 hours analyzing your lease for any traps. Like I said, if you don't have a lease and you're looking to start a practice, we can dig into the kind of demographic, the size of the space that you're looking for, and see what's available. That does have a $2,000 value, but thanks to Heather and BMO for kindly sponsoring this as a complimentary personalized lease review, which I'm offering to everybody who's attending. So if you do, you have my details, my email address. I am going to, if there's any questions, now would be a great time to put them in the chat. What I'm going to do is, I have a poll, just an exit poll, which some of you who may have missed the beginning of the webinar, I would just appreciate if you could take a few minutes just to fill out this exit poll. That just gives us a little bit more information. Hopefully you can all see that on your screen. So if you could just, are you presently a tenant? Do you have a lease? Does it expire? Do you know when it expires? Is your situation urgent? Would you like a complimentary consultation, not just with myself, with Heather as well? And what's your situation, right? Would you like BMO to review your current financing to get some feedback? So I'm going to leave that on the screen for a little bit. Any questions? We still have, we have about 10 more minutes that we could answer some questions. you can put them in the chat. Feel free. Don't be shy. Heather, anything to add?
Not that I can think of offhand, unless somebody has a question. Maybe maybe you can share with us a few of the situations you've seen dentists get into, just to give people an idea of what the risks can actually be. I mean, you already have, but it always helps to hear.
Yeah, I mean, there's a number of, like I said, that I can think of a few. There was a dentist that he sold his practice just prior to COVID, and a young associate who took on too much debt at that time, obviously pre-COVID, and COVID came in, and unfortunately couldn't keep the rental payments and defaulted on the rent, and was 3 months in arrear 3 years after buying the practice. Now the problem here was the selling dentist, he was continually liable. So retiring dentist is probably in Florida or somewhere nice on the beach, and he got a call from the landlord to say, sorry to be the bearer of bad news, but unfortunately your buyer is defaulted. He owes $20,000 of rent arrears, and there's still 7 years left of term.
Wow.
So last thing that dentist wants to do is come back and start practicing.
A little prevention goes a long ways.
Okay, it wasn't a question, it was a thank you from Bruce. This is very appreciated.
One thing I would say is, in my world, oftentimes we come across dentists who are looking to set up a new clinic or purchase a clinic, and they come in with a lease, and the first thing I look for is the demolition clause. And to your point, we do see a lot of them in Vancouver, and it can be, at times we might be able to get around them or find a way to mitigate. When I showed you that slide about risks, that would be a risk. There are ways you can mitigate some demolition clauses. It depends what the lead time is. It depends on all the peripherals, but oftentimes we've also seen demolition clauses that kick in like almost immediately for 12 months. And that becomes a situation that's nearly impossible to get around, because of course the risk is you've just taken on all this debt. You haven't had a chance to get established and to increase or build your revenue, depending on if you're a startup or an acquisition. And the potential is that you could now be looking for another location. So, is there even anything available in the area, first of all? And then to suddenly, as you're trying to build your patient base, to suddenly then be shuffled over to a new location, it's just not a good scenario. So that's the time to call Lee.
There is one question, Heather, just asking about what the kind of current interest rates that we would be looking at. I know it's probably a bit broad, but can you speak about that a little bit?
Yeah. So in the market right now, the rates are for dentists typically would go as low as prime minus 0.25%. And of course that floats with prime. So if you're looking at a fixed rate loan, that would be and most people aren't at this point, but if you were, that is a variable. Like, that changes. Shouldn't say variable, it's not good. It fluctuates daily. But I would say as low as prime minus 0.25 is pretty much standard market right now. Each loan each situation is adjudicated based on the overall picture, and no two are alike. It's like fingerprints. Everyone is individual and unique.
Excellent. Okay. Any more questions? happy to let everybody go a few minutes early if there's no more questions. Ravinda, what about fixed rates? One question for you, Heather.
Yeah, fixed rates, because fixed rates are based on banks, cost of funds, or the bank's cost of funds, then it's variable every day because it changes every day. So I can't really give you any specifics on that. But if you have a situation that you're looking at, if you wanted to get that, pricing, then we would look at the whole situation. We would assess the price and the rate and give that to you. It would be tentative. It can be locked in, but it has to be fairly close to the drawdown date. So I know that's not very specific information. I apologize for that, but it's just the nature of fixed rate term loans. Just remember, once you fix a rate, you can't just pay it off without a penalty. That's the key thing about the fixed rate term loans.
Okay, thank you. I think that answered the question. Okay, any more questions? We really appreciate everyone's time this morning or this lunchtime, depending on where you are based. Okay.
I'm going to put my contact information in the chat because I don't think it was on there. So I'm just going to put my email. You can email me. You can even find me on LinkedIn and send me a message. I'm pretty engaged and I typically see them pretty quick. I'm a little too engaged sometimes. and even into the night sometimes, which I don't recommend, and I'll give you my phone number.
I'm sure that they'll be able to get hold of you, Heather.
Yeah, I'm pretty accessible and you'll find me pretty user friendly. So even if you're in a situation now with whatever lender you're with, if you have any questions, I'm always happy to help. And if you're looking at a purchase, you can shoot me the appraisal and I can look at it. Probably 15 minutes. I can give you feedback on the appraisal. So, I can spot things in the appraisal, maybe questions you should be asking or, that type of thing. So use me as a resource because I'm here and I have connections in the bank for anything, whether it's personal mortgages or if it's wealth or anything, along those lines, lending, personal or commercial, I'm here. So just shoot me a quick email or LinkedIn message or however you can even send me a text to that phone number and I'll see it.
Okay. Thanks again, everybody, and wish you all a nice weekend. And hopefully we will speak to you all soon.
Thanks, everyone.